Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Thanks, Jack. This is a question I've not seen before. Scott says, why does the U.S. feel it needs to save the world via the weak U.S. dollar? Is the U.S. sacrificing its economy for the benefit of the world? What do you think, Jack?
Well, my answer is yes. I think that's a great question, and we've written about this before. One of the problems with the U.S. dollar, inherent structural problems, goes back to the fact that the U.S. dollar is the world reserve currency. Because the dollar took over the role for gold as a world reserve currency, it is the fuel that has to pump up asset markets around the world. Every time we've seen dollar credit come out of the world, we've seen major problems in global asset markets, major. So structurally, it almost dooms the U.S. as a country, because of its role as a reserve currency, to run these current account deficits, because they have to keep a lot of dollars out there to basically keep the world lubricated. Now, the problem is they don't have to do it to the degree they're doing now. The problem now is, and I think they are explicitly sacrificing the dollar now. That's why I say yes to this question. The U.S. made all those, the Fed came in and saved all those central banks and basically the European banking system with all its swap lines. And they continue to pump out massive amounts of dollar credit to try and pump up the U.S. consumer and also keep China afloat to a degree. We're in that G2 world, meaning U.S. versus China, that symbiotic relationship. And the U.S. is using the dollar to try and create the wealth effect for the U.S. consumer to get him buying again. And in order to do that, there's more and more massive stimulus out there in the globe. I think it's a huge mistake. I think if the U.S. were to step back, take dollar credit off the table, and let some of these morbid banks and financials, these financials go under, and these morbid companies go under, that's the way you cleanse a system, and the dollar falling in and of itself will help stimulate demand back in America, as money flows in. But they're doing just the opposite of that in terms of, I think, and the dollar is the sacrificial lamb for the current policy.
Good point. Next question. This is back to another piece that you've written, Euro implosion. William says many countries are in trouble in Europe, but not Germany. Is that behind the euro strength, or is it just the U.S. dollar bear trade? And then I'll just add a point, Jack. What's going to happen with those countries? I mean, what are their choices for we talked about this a little bit prior to the webinar. What can Greece do? I mean, it seems like either way, I'm just picking on Greece, but it could be Portugal, Italy, Ireland. If they exit, things could actually be more dire than being under the euro, correct?
That's correct. Yeah. Just starting with this question, and I'll get to that part of it, Steve. Germany is the core of the euro. The euro would not have happened without Germany. The German D-mark was the anchor for it. It basically was the euro, and other countries in the European Union pegged against the D-mark to create the euro. So Germany is the big dog here. The euro was set up for the incentive of Germany, so Germany would have a captive industrial market. That's why Germany gave up its D-mark. People, said, why would they? They worked so hard to keep it. But what they gained from it was this captive European market, one currency, make it more efficient for German exporters, industrials to, push goods, and dominate the continent, so to speak. So if Germany gets in trouble, the whole thing unravels. And if the incentives, if the disincentives for Germany start to outweigh the incentives, Germany will start to pull back, and then the European monetary system. That's the first sign of an unraveling. Germany is the key. But the reality is these other countries that are part of, by treaty, the Maastricht Treaty and other treaties that are supposed to keep their budget deficits in line, 3% of GDP. Some of them are running 12 to 13% budget deficits to GDP. They haven't made the transitions in terms of their labor and their economies. They haven't made them more flexible. So the productivity is declining against Germany in a big way. But these countries were able to borrow at German rates, and that's where Germany has sacrificed itself and sacrificed its capital to basically subsidize the entire system for the industrial strength that it helped create. As to whether or not what happens here when a country like Greece that is so far beyond any of this treaty obligations and should not even be in the monetary system, the ECB, European Central Bank, and the European Union is really doing all they can to keep them in emergency meetings. They can overlook certain periods for, so they'll continue to paper over this. But if you see a couple of them, start to go, and the disincentives for Germany change in a big way, then you have the real potential for unraveling. They'll keep one basket case in and keep making excuses. But if another comes out and then Germany is forced to have to subsidize even more, I think the game could be over. So Germany really is the key. Most people say by legally they can't come out of the European monetary system, but it's not true. I've read a lot of research that says they can. And think about it, if they can and they devalue, let's say Greece, for example, one of the benefits for them leaving the system is if they leave the system and then they massively devalue their currency, they get to pay back their, the debt that they created under the euro in a much, much cheaper currency. They don't necessarily default on that debt. They just pay it back, with a much cheaper currency of their own. And they use that falling currency as kind of the pressure valve that now they don't have because they have the straitjacket of the euro. The euro is creating pressure on all these countries because they're having to make the adjustment domestically instead of through the currency. That's why you're seeing the UK economy, although the finances are in trouble, the UK economy is starting to show some signs of rebound because of the massive relative devaluation of the British pound. It was able to fall during this period while the euro has stayed very, very strong. So it's a very interesting setup. Not to mention the baggage of Eastern Europe that they've taken on, to try and shore up. That's a whole nother part.
Jack, what would be your trade then if you saw that the euro looked like it was just going to dwindle, it would be shattered? Is it the Swiss franc? Is it the dollar? Is it the Japanese yen?
No, it's the
where
dollar.
would people hide?
It's the dollar.
Yeah.
It's definitely the dollar because that's a major global macro event. And again, you only hide in the deepest capital markets when you see something like that. So it has to be the dollar. You're shorting against the euro.
Next question, Jack.
You're long. You're shorting the euro against the dollar.
I got it. Yeah, it'll be back to 2008. Maybe even bigger than 2008 though.
Yeah, I mean, if you had to say what's the probability of it breaking up, not high, but potentially growing if we have another risk event. The probability is it stays together, but the reality is they're inching up, and you see that in the currency default swap, in the those swaps for the bonds. They're starting to cost more and more for those core countries in Europe, and you're seeing risk spreads rise on those individual countries, individual sovereign debt relative to Germany. That's a sign that people are getting nervous about the system.
Wow. Next question. TJ says, can your fundamental price analysis be used in other markets like stocks or commodities? Jack, I mean, I think you do mention that, the idea that the currencies are important because if you want to go trade something else, it almost leads you one way versus another. If you see that the Canadian dollar, for instance, is strong, you probably will know that commodities are strong or vice versa, correct?
Yeah, I think anytime you can look at, what I've laid out in terms of this fundamentals isn't necessarily purely a currency thing. It's kind of a money flow thing. What's happening in the world, in the global economy? I think any of that analysis that you do on that side of the fence will help you, and no matter what you do, whether it's bonds or stocks or commodities trading.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.